that. It's just kind of a summary page. So we got sole proprietors. Let's dive into sole proprietors. A sole proprietor, what is that? What is their income? It's income minus expenses is their profit. So, all right. A lot of the times these days, I hear my clients call me up and say, Sam, I've got a business. It's an LLC. I go, great. What type of LLC? And they go, I don't know. So to the IRS, for us, for our purposes, LLC does not mean anything. Okay? We care about sole proprietors or single member LLCs. Those are going to be filed on the Schedule C, and those are the people that we can help. Okay? So if they are saying, hey, I have an LLC and it's a partnership or a corporation, S Corp or C Corp, we can help them get in touch with people that will help file those corporate returns and get us the K-1, but we're not going to do it for them. Okay? So a lot of the time, especially when they're calling up and they're brand new to this, a lot of the clients just know LLC. They don't know what type of business they are. They don't know what type of business they want to be. And so, when they call up and say, I have a business, we want to ask a couple of questions to figure out, is it a sole proprietor, a single member LLC, or is it one of the other ones that, we can help guide them, but we wouldn't file for them. Okay? So our main thing, the sole proprietorship or single member LLC. Okay? Single member LLC, also known as a disregarded entity. That's why we deal with it, because it is not its own entity. It's not its own structure. It is a sub of the taxpayer. Okay? The client needs to fill out our Schedule C worksheet or provide us with a clean profit and loss worksheet. Okay? We're getting more busy with small businesses every year. So I'd really like it if we could be a little bit more strict on what we're allowing our taxpayers to give us, because if they just keep giving us a bunch of summary notes or yellow pads with things and arrows, and it's not a clean profit and loss, we really have to take a bunch of time to get it onto one of our worksheets so that the process can move smoothly. So I really want us to lean heavy on those worksheets. If our client's giving us a good profit and loss, what I'm calling a clean profit and loss, that is easy to understand, has everything listed out, then I'm not mad if we take that. I'm not going to make them put it on our worksheet. But if it is 2 or 3 pages, it should fit on one page. It should really fit on one page. We'll say front and back, but it should fit on one page. And because for a sole proprietorship or single member, it's a really simple structure. It's really just you've got the owner, and then you've got the expenses. So there's some characteristics with a sole proprietor. It's not super important for our terms, other than that the owner for our terms is the taxpayer, and yes. Question? Can't hear me? Hello? Okay. So we got our profit and loss. So what is on a P&L? A profit and loss, a lot of you guys have probably seen these before if you've been doing business tax returns, but maybe you haven't. So at the top of the page, you've got all the business income, their gross receipts, everything that came in. Okay? Sometimes we have to tell our clients, hey, I don't want your W-2 wages. I don't want what you got from Social Security. I just want what's business relevant. So at the top of the page, we're going to put all that business income, okay, all that money that they're getting from doing whatever job they're doing. And then we're going to have them group the expenses by category, okay? Anybody that's been doing this with me for years will know the different categories. Rent, utilities, supplies, materials. I have my Schedule C worksheet over here. Cell phone costs. Pretty much everybody these days is paying a cell phone bill. And so, we want the taxpayer to group them by category and total it for the year. While not every deduction is 100% allowed, we want our taxpayers to give us the 100% numbers. We don't want them to try and figure out, oh, I have a 67 cents per mile rate. I'm gonna do the math for you. I'm gonna give you the final number. We don't really want our taxpayers doing that for us. We want them to give us the full number, and then, like, if there's meals, we'll take the deduction on our end. We'll make sure that it gets down to the correct number. We want them to give us the 100% numbers. Oh, we want us to give also only their business use numbers. We don't want them to give us, both their business and personal numbers together. But a lot of the times, they're just giving us what they paid without any sort of allocation. So, as I brought up before, and I will again, we always want to talk about allocation. We always want to allocate between personal and business. Okay? If it cannot be proven to be 100% business, find something to make it to allocate it. Find some way to allocate it. The IRS will take any reasonable method. If you try it all, the IRS will generally side with you. But what I tell my taxpayers is, if you're going to go 100%, that is 100% business purpose, the IRS's only option is to say 0. If we say, this is 71% business purpose, then the IRS can go, we don't think it's 71, we think it's 65. And then we can come back and go, oh, no, we did our calculations, we actually show it's 74. So you owe us money, So if you are allocating between personal and business, you can keep the client in a aggressive status, but still have a leg to stand on if the IRS, if the taxpayer is audited and the IRS asks more questions. Okay, this is something I have to get better at as well. But when we're doing our Schedule C worksheets and we're marking things up and scribbling things, we want to rescan it after we've done our markups, so that we can have a scanned and final version of, what did we actually get to. I know that a lot of times we'll have our worksheets out, we'll have the client on the phone, they'll be, firing numbers off at us, and we're trying to keep up. And so making sure that we scan that document once we have gotten it down to its final form, we want to make sure we can do that so we can recreate stuff from our files if need be. And that's that last bit, is to transfer the worksheet from our software into the Drake software, from our worksheet into the Drake software. Okay? For a deduction to count, for something to be a true business expense, it must be ordinary and necessary. Okay? And for an expense to be ordinary and necessary, that is facts and circumstances. There is no unified list of all the things that are definitely a business expense. Okay? And so the facts and circumstances can be a yes for one client and no for another. Do I have an example on here? If you've got, one person's just a construction business and one person is an accountant, the construction business may need to buy dirt and have it shipped somewhere. I'm making stuff up at this point, but buying this dirt and using it, that's a legitimate business expense for this landscaping company. Whereas buying dirt for an accountant and an accounting firm, that's really not a ordinary and necessary for an accountant. So it would not be a reasonable expense. Okay? Going to get allocation again. I really want to stress this. The IRS will accept a reasonable method of allocation. Put in the notes. What type of allocation that you did. Did you do it based on square footage? Did you do it based on time? Something that, speaking on ordinary and necessary, about October time, right when extensions were coming due, I had 3 or 4 clients in about a week come up to me and say, can I claim my dog for security? Every single one of them said it like that. Can I claim my dog for security. So I'm guessing something was going around on TikTok or Instagram saying that you can claim your dog for security. And every single one of them, I asked, well, is this dog only for security, or is it also a pet? And every single one says that, it's really also a pet. But they all wanted to try and find a way to claim their dog. On one of them, who had a plumbing business and kept their tools at home, we came up with the allocation method of when the taxpayer is away from home, his dog is his security method. Okay? You need to look at the facts and circumstances. Does not always work, because this was a pit bull dog, a big dog. We're going to allow that to happen. It wouldn't really work for a Chihuahua. But the main part of this is that we are allocating. We're going to be allocating, only the 8 hours a day that this taxpayer is at work as the amount of time this dog is anything other than a pet. Okay? Because in the IRS's eyes, a pet is presumed to be, or an animal is presumed to be a pet unless it can be shown otherwise. And if you allocate, you're going to have a much higher likelihood of passing any argument, because you're going to be acknowledging, yes, this is my pet. Yes, I spend money on it in a personal manner, and that's not deductible. But there's also this business use portion, and I'd like to get some deduction for that. Okay? So that's anything that's mixed use. We were just talking about a dog, right? That's anything that's mixed use, okay? Office and home allocation can be based on square footage. Not super common because offices aren't that big in Hawaii. If there are multiple offices in a home, or when we get to rentals, if there's multiple rentals in a home, you can go by number of rooms. Okay? Cell phones. Everybody's got a cell phone plan with their spouse, their kids, their parents. And so they might have 4 or 5 phones on the plan, and they're telling you it's $300 a month for a cell phone bill, and trying to write that whole thing off as a business expense. No, we're going to allocate it by the number of phones on the plan. That is my common way of doing it. If the taxpayer is very on it, I would not be opposed to a taxpayer totaling up line number 1, the most expensive line, and giving me that number for just their portion, but they'd have to be able to show they went through the work, and actually got that number. If they have 1 or 2 receipts, I'm not mad about it. But my general rule is to just take the total cost, divide by the total number of phones. Okay? Auto expense. As a general rule, standard miles. 67 cents per mile this upcoming year. As a general rule, we want to go with standard miles. It's simpler. We're not going to get hit by any recapture rules. The standard miles is really a good method of expensing your automobile. Okay, so the taxpayer has to provide us with the business miles and personal miles to generate that ratio between business and personal. If they are using the standard miles and they give us the business miles, we can estimate their personal miles only as long as they're using the standard miles. Okay? If they're trying to use actual because they think that it's better for them, or we've actually run the calculation and it is better for them, then we need to have them document both business and personal. But if we're using the standard miles and they can provide us with the business miles, we're good to go. Okay? Their business log should have a date, a start location, an end location, miles traveled, and a reason. I kind of left that one out. Okay? It doesn't have to be, there's nothing specific, there's no specific log that they must keep, but it must have a date, a reason, a start location, end location, and miles traveled. A lot of people included odometer reading on that one. It's not mandatory, but it doesn't hurt. Okay? The log must be written. I know that all of us preparers, we've seen the question on our worksheet. Does the taxpayer have a mileage log? Yes, no. Is that mileage log written? Yes, no. Okay. So if they say, yes, it is written, we want to document, yes, that it is written. And I would prefer that we got some page, a summary page, a final page, a page with some number that we're going to put down. It's not mandated that we have that, but it would be best if we're going to be claiming standard miles that we have something to document why we put the number that we did. Okay. Now, we're not required to get this log, but we are required to inform the taxpayer that the IRS wants it on a daily basis. A lot of the times, my taxpayers don't understand what that means. They go, what do you mean? So I say, all right, I want you to show me where you went on July 15th of 2024. Okay? And they're going to start, going like, I don't know how to do that. Well, this is what the IRS wants. I want you to show me, where did you go on September 1st of 2024? That's the kind of detail that the IRS wants. And I just make up 2 dates out of thin air. I don't particularly care what the dates are, but to impress on the taxpayer that the IRS wants daily logs of this kind of stuff. Every time you drive your car, if you want to take a deduction on it, the IRS wants to know, why did you drive it? Where did you start? Where did you end? How far did you go? Okay? So, standard miles, insurance, repairs, gas, registration, depreciation, things like that. The parking and tolls are still can still be expensed. What does that mean? That if somebody pays for parking and or tolls, that can still be put on their business as an expense, even if they're taking the standard miles. Okay, and commuting miles are not business miles. If you're driving from your home to your first work location, that's commuting. That is not a business use. But if you have a home office, you may be able to deduct traveling from your home office to an offsite location. It's not always a slam dunk, but it is a lot of the time. I did have a musician in here earlier today. We were talking about miles, and he was asking, can I do round trip? So we talked it through. Before he goes to his gig, he's up, he's at his home, he's practicing, he's getting his notes ready, he's getting everything ready for the show. He leaves his home office, goes to the show, does the show, comes home, goes straight to sleep. I told him, we're definitely going to take your mileage going there, but he's getting done at 12 o'clock, 1 in the morning, coming home and going right to bed. We're not going to count his miles home. In a very similar but different world, we have a real estate agent. They wake up in the morning. They both have an office at home. Real estate agent wakes up in the morning. They start their day. They get on their computer. They're checking their emails. They're checking their logs. Then they have to travel to a showing. They travel to a showing, and then they come home. We're still the middle of the day, 1 o'clock, 2 o'clock. They continue working and are continuing to make deals, to do emails, things like that. Both directions would count. Okay? And so you can kind of see how some people will get both directions for their office and home travel, and some people will only get one direction for their office and home travel. It can be a little bit confusing, but just you really want to find out, is the reason for their travel to continue working? And if it's not, then that direction would not be considered deductible. Okay? Office and home. So to get this wonderful deduction of driving from your office and home to an off-site location, you must first have an office and home. So you must have a space in your home exclusively used for business. Okay? If a room has multiple uses, like it's got a day bed in there, and it's got your office desk in there, you're going to want to go back to allocating, right? That's what I've been talking about. You want to allocate just the square footage of the desk and accoutrements like a printer table or a filing cabinet or the chair. You want to take the square footage of that stuff compared to the whole home, and you don't want to just go with, it's a 120 square foot room. You don't want to take the whole room if it's not 100% business use. Because the term is exclusive. The term is exclusive, so any sort of non-business use means it's off the table. So if a room has multiple uses, go down to square footage for the of the desk. Okay. We allocate between personal and business use. So when you have an office and home, then the expenses on the home are also going to get to take as a proportional ratio of personal use, the total square footage of the home, and business use, the square footage of the home office. Okay, that's going to calculate a percentage, and you'll multiply that percentage through the mortgage, homeowners insurance, or renters insurance, as well as utilities. Okay, and if you have direct expenses to your home office, like putting up shelvings or things like that, those are going to be directly applied to the home office. And as far as entering, like this is what's going to happen on the final return. It will have that percentage multiplies through. While we're inputting into our software or most tax softwares, you're going to input the 100 percentage, and the tax software will calculate your percentage by business and personal square footage. Okay, so there is a way to accommodate for that. While we will be calculating these numbers as a percentage, when we're entering into our software, we use 100%. And that may differ from software to software, but at least for Drake, you enter at 100%. Okay? So, we've gotten our automobiles, we've gotten office and home. The next big deduction that's just not a general category is going to be depreciation. All right? And depreciation is just the use of an item over time. Okay? It is just the expense of an asset being used up over time rather than writing it off all at once. Okay? So, as a general rule, items over $2,500 or expected to last several years should be depreciated. Okay? That's going to include appliances, automobiles, factory equipment, things like that. It's generally sometimes it does, sometimes it doesn't include computers, depending on the price of the computer, or things like that. And it's not a hard and fast rule for the $2,500. If it is a consumable item, something that will be used up very quickly, even if it is more than the $2,500 item, we would expense that directly and not depreciate it if it was a type of consumable. Okay? Depreciation on an auto. Going back to that standard miles, we really shouldn't see this too much. We really shouldn't see too much auto depreciation because we want those standard miles. Okay? So we want to review. Okay? You don't take it if you're taking standard miles. Now, there are limitations on cars and trucks. And that's going to be a listed vehicle. Okay? And so whenever you put an automobile on the depreciation worksheet, it must have the business percentage calculated by business and personal miles. That must be calculated, as well as limitations on cars and trucks. You may have heard of the weighs more than 6,000 pounds, so I'm going to write it all off at once. That's what they're talking about here. If there are assets, if there are vehicles more than 6,000 pounds, it may be written off above the limitations. The limitations for automobiles and light trucks, I believe, is something like 18 to 20,000 per year would, or 18 to 20,000 in the first year is the max that a listed automobile can have. Okay. Now, if you've got a client that has large assets that they want to expense faster than the expected life of the item, you've got things like 179 and bonus. Okay, I want to be clear to tell you guys that these two things only work for business assets with more than 50% business use, and it should be clearly documented. The clearly documented is really more for automobiles than anything else, because if somebody has a tractor or something for their business, most likely it's going to be above 50%. Or if they have a fridge in their business, in their break room, that would be above 50% business. And this 179 in bonus allows us to write off items faster than the standard rate. Okay, and so the 179, that's section 179 of the tax code, and for our clients, for most of our clients, if you enter anything in that 179 deduction, it will allow them to write it off all this year. Okay, two things to note: it will only ever allow you to write off your business portion. So let's say it was a 80% business asset. You'd only be able to write off 80% of the total cost because it's only an 80% business asset. And then if at any point that asset were to fall below 50%, the taxpayer now needs to recapture that depreciation. So now that taxpayer has new income they didn't know about. So be very careful if you're using 179 in bonus, because if it ever falls below that 50%, it's not going to work. I've got a phone call coming in. I'm just going to deny them. I'm teaching. All right. So 179 in bonus. I think that is more risky. If you are going to go through any of these accelerated methods, I want you to have a long conversation with your taxpayer, letting them know by writing it off early, you're making this item worth less on the books. So if in less time than the life of the item, let's say that if it was a 5-year car, in 3 years they wanted to trade in and go up in car, if they have accelerated depreciation, that trade-in is now a taxable event, recapturing the depreciation and adding new income onto this taxpayer. They probably weren't ready for that. So if we are going to do anything with accelerated depreciation, we want to make it very clear to the taxpayer that if they sell this asset, they are now going to have possible tax consequences and gains. Okay, the two types of depreciation methods that we use are going to be straight line or makers. Straight line is just the total life of the asset divided by its price. So every year is going to have about the same chunk. Makers is an accelerated version where in the first 1, 2, and 3 years, most of the asset is fully depreciated. Year 2 is the best year for makers. Year 2, and so by that 3rd year, most of the asset is fully depreciated. I think 75% of the asset is depreciated in those first 5 years, and so it is a accelerated depreciation without having some of these pitfalls of really accelerated depreciation. So that's straight line and makers. Makers also sometimes called double declining balance, but I call it makers. Okay.